Welcome back. And in our business news, UAE non-oil foreign trade rose by 17.3 billion dirhams to 320.3 billion in the first 4 months of the year, compared to 303 billion dirhams in the same period the year before. The latest Federal Customs Authority statistics show that exports increased by 10% from early January to late April this year, raising the UAE non-oil exports by 18.4 billion dirhams, up from 190.6 billion dirhams in 2011 to 209 billion in the same period for 2012. In terms of weight, total UAE foreign trade hit about 31.8 million tonnes in 2012 January to April, including 17.5 million tonnes in imports, 11.2 million tonnes in exports and 3.1 million tonnes in re-exports. The Asia-Pacific region retained its first place among the UAE top non-oil foreign trade partners, with a total trade of 145.6 billion dirhams, 46% of the total trade in the first 4 months, while Europe came in the second place with 80.2 billion dirhams, 25% of the total trade. Etihad Airways and Air France-KLM have signed an agreement to code-share on flights across the airline's networks. The agreement is the first phase of a larger strategic partnership, which is set to start on the 28th of October. The wide-ranging code-share agreement will see Etihad Airways and Air France-KLM offering joint codes on destinations in Europe, the Middle East, Asia and Australia. GCC-based financial advisors and retail investors are becoming increasingly risk-tolerant and optimistic despite the various challenges like local and global economic volatility, according to the latest report. According to the 2012 Middle East Investment Panorama report from Insight Discovery, 60% of financial advisors prefer global emerging market equity funds, while the hottest alternative asset classes are gold, commodities and listed real estate. Meanwhile, the vast majority, at 83%, of GCC-based financial advisors use the products and services of international asset managers. The report also revealed that financial advisors dealing with international life insurance companies has also risen substantially to 63%. There are also around 3,700 financial advisors working in the UAE, a far bigger number than previously estimated. As the banking industry looks towards strategic, innovative products and service development for growth, First Gulf Bank is focusing on the education sector for its clients. The MENA Islamic banking industry has been forecast to more than double to $990 billion by 2015 through innovative schemes. And in line with this, First Gulf Bank is encouraging parents to save for their children's education with a savings option that rewards regular savings through interest rates. The bank recently launched its Child First savings program and is one of the few banks in the UAE to offer this kind of product. It takes into consideration the high cost of higher education and in turn helps parents save for their children's future.
We do notice that, like everything else, the cost of savings, the cost of children's education has gone up indeed. We are very driven by customer-centric innovation, and the latest product that we've got pursuing that strategy is the Child First savings account. The account can be opened with as little as 5,000 dirhams to earn interest. Otherwise, it's 3,000 dirhams. Each month, the parent is required to deposit 2,000 dirhams or more, and that entitles one to, as long as the account balance has grown, entitles one to an interest rate of up to 1%. Additionally, every quarter we have a draw of where the lucky winner, the lucky account holder, would be reimbursed up to 100,000 dirhams towards their children's tuition expenses.
Commenting on the launch, experts say that their banking product will also balance the needs of its stakeholders and in turn provide parents with a rewarding, sustainable way to save. Child First is available in all FGB branches across the UAE. And with that, let's now take a look at the stock indices across the GCC. And looking to other news, the US dollar pared some of its gains in trading last week as improving data saw risk sentiment take asset classes higher across the board. Much of the optimism came from last Friday's US non-farm payroll report, which showed decent job growth during the month of September. So to find out more, we earlier spoke with Gaurav Kashyap, the head of the DGCX desk at Alpari Middle East, for his views on the report and what to look forward to in trading this week.
By far, the headline reading in last week's trading session was the US non-farm payroll figure, which, although was very mediocre in our opinion, really saw risk sentiment being driven back into the markets. Now, the figure showed 114,000 new jobs added. This is slightly lower than expectations of 115,000. But by far, the most eye-catching figure was the drop in the overall unemployment rate when it came in at 7.8%, down from expectations of 8.2%. Now, this is obviously the lowest reading since January 2009, and it was backed by an increase in the labor participation rate, which also was up from 30-year lows when it came in at 63.6%, up from 63.5%. Now, is this enough to see Obama secure re-election for a second term? We'll have to wait for one more non-farm payroll number to make that announcement. But overall, Obama did make some positive ground, and the figure was perceived to be very positive, which is why we saw risk appetite close the week on a very positive note and the US dollar weaken on the back of that. Looking at this week ahead, we eagerly await developments from the Eurozone finance ministers' meetings that are taking place in Luxembourg. A couple of things on the agenda will be Greece's third tranche of bailout money, along with developments coming out from Spain with regards to their possible request for a formal bailout. Remember, Spanish bond yields have continued to increase through trading last week, and Spain is getting close to that critical level whereby they may be putting in that formal request. So we'll be watching developments from there. Across from the UK, we're expecting to see industrial production, manufacturing production figures both remaining in the negative. And overall, we're expecting trading to remain mixed and in a choppy range for the week ahead.